Hey everyone, and welcome to the Rare Liquid podcast. In today's episode, I'm going to be speaking with Ojima Agata, who is a fellow Wharton MBA classmate who also went to Princeton for undergrad, then to JP Morgan, and then to Carlyle in their real estate PE group. And I learned a ton from this conversation because I feel like real estate is an industry I really am interested in, and also is one that's not super well covered in the PE industry. And so I think you'll learn a ton from this conversation and hopefully maybe spark an interest in considering real estate to be maybe an industry in the finance world that you join in the future. Now, before we get started, if you're listening to this episode because you're interested in a career in private equity, I highly recommend you check out the PE Investing Certificate program being offered by Wall Street Prep and Wharton. This program is sponsored by top firms like Blackstone, Carlyle, and KKR, and over 8 weeks, you can learn at your own pace through this online course that's taught by Wharton professors, Wall Street Prep's PE program director, and real estate PE investors, including David Rubenstein, the founder of Carlyle, and Martin Brand, the head of North America PE at Blackstone, who will cover topics like the PE deal process, valuation, how to think like a private equity professional, and more. By completing the program, you also unlock access to the alumni member database, fireside chats with PE investors, and exclusive networking events with the world's top private equity recruiters. This program runs 3 times a year, and be sure to use my code rareliquid to get $300 off, and also sign up by the early registration deadline to get an additional $200 off as well. And I'll leave a link to all of this in this episode's description. All right, Ojima, thanks so much for making the time and jumping straight into it. Can you just start off by giving us a bit about your background?
Yeah, no, thank you. Great to be on the podcast. I'm originally from Nigeria, moved to the States around in 2007. Initially moved to Baltimore, and I've kind of hopped all over the country. I've lived in about 7 different states in my time here. Most recently, I was in DC working at Carlyle in their real estate private equity fund, and now I'm at Wharton. I'm a first year at Wharton, so it's been awesome being here.
Got it. And I know at your time in college, you decided to major in engineering, and then you kind of made the pivot to finance. And so can you walk us through a little bit about your college journey and why you decided to make that pivot?
Yeah, no, definitely. So I applied to college undecided, got in undecided, and was really wondering what I wanted to do. So before starting college, I spent about a month in Nigeria with my uncle. He's a real estate developer in Lagos, and just shadowing him, like seeing his work, like going from site to site, like building these like things, building houses, building schools, hospitals, offices that people wanted and needed was really inspiring. And that inspired me to be a civil engineer, thinking that's the best way to get it. Somewhere in my junior, like towards the end of my sophomore, like starting junior year, I realized civil engineering was probably not for me. They did a different role from what my uncle did. My uncle was more probably a developer in the parlance of this term than actually an engineer. And I looked into switching. However, like taking all the courses required for a different major, switching out of the engineering school into the School of Arts would have been like a challenge in terms of like graduating on time. And so I decided to stick it out and finish the degree as a civil engineer. However, due to the resources at Princeton, I was able to go through recruiting, and I recruited for the securitized product group at JP Morgan, specifically focused on CMBS, commercial mortgage-backed securities, which is like real estate lending. And that was really cool because like I still wanted to be involved in real estate. I still think it's really cool. There's nothing like going to your own site and like seeing an asset, seeing your asset, like. No one can say, oh, I saw a bond the other day. But I can say, I saw my building the other day. So, yeah.
Got it. And before we get into your time at JPM, I actually wanted to ask a bit about your time at Princeton because obviously it's one of the best, if not the best undergrad. You're probably a little bit biased here, but can you tell us about, I know this is kind of a broad question, but what your experience was like there? I mean, I feel like a lot of times at these top Ivy League schools, you're kind of taught that anything is possible. The world's your oyster. I mean, is that the kind of feeling you got? And what were like the major, I guess, pros and maybe even any cons from your time at Princeton?
Yeah, no, definitely. Oh, wow. Princeton, complicated question. Thinking through it, the first thing that comes to mind is it was hard. I had done really well in undergrad, I say in high school, I mean. And coming in, I thought, okay, I've done really well. I crushed the exams. I took APs and whatnot. And I was going to do well my first semester. And I was a bit cocky, not going to lie. And I was humbled. It wasn't a great semester. Additionally, I decided to play a sport called sprint football, which is lightweight, like a lightweight football that only about 9 schools do. Football with a weight limit, and that I think made my experience. Like the group of guys I got to play with, like some of them are still my best friends till today, and just coming in with that community at Princeton really made and shrunk the school to a size that was really manageable, really easy to assess. And so like that definitely made the experience positive. But I mean, Princeton, like similar to a lot of the elite schools, is like can be a very tough place. Like academically can get competitive. And so like those definitely happen. But like I was able to form a community that was like really helped me through my time there.
What was your favorite class at Princeton?
Favorite class at Princeton. So as part of the engineering requirement, you can only take engineering classes. You have to take like classes in other departments. We had to take a class on like basically a sociology class like that. And I took a class called Hustles and Hustlers.
Oh, interesting.
And
not exactly what you would expect of a title of a course at Princeton, but yeah, cool.
Yeah. I mean, I'm sure that was in the official course title.
Okay.
I've since forgotten the official course title, but the class basically looked at the ways like the various parts of the underworld like worked and functioned from a sociological perspective. And the professor had done like research into like the mafia, the Italian mafia.
Got it. And then when you were starting to recruit for your first job after undergrad,
Yep.
I don't know, what really pivoted your interest towards finance? Was there like someone you spoke with or like a mentor or some kind of like company that came to campus that really sparked your interest?
Yeah, no, definitely. So a couple things like sparked my interest. First off, like I have like one of my like family friends from Nigeria had immigrated earlier, and her husband worked in finance, and so like talking to him and like talking with him like was really impactful, and like realizing finance was an option, as no one in my family had done finance before. So that was the first thing that was instrumental. Secondly, like the companies came to campus, and it was informative to just go to their info sessions and see what does a bank do? What does an investment bank? Because prior to Princeton, my real interactions with a bank, like you ask me about Bank of America, it's where I have my checking and savings account. Like, and so going and seeing, this is what an investment bank does, that they help like finance buildings, finance companies. And in a sense, like almost everything we see around us has been in some way touched by finance. And like that realization was pretty cool.
And how did you end up choosing the division that you did? You said it was securitized products?
Yes, securitized products. So JP Morgan came to campus as part of the recruiting aspect. And I was talking to the lead and I mentioned, hey, I'm interested in real estate. And he's like, I'll put you in touch with someone. And the person he put me in touch with was within the who did CMBS at JP Morgan. And I found it really fascinating because in the CMBS market, it's, to get a bit technical, it's kind of like, it sets a lot of the interest, like debt rates for the rest of real estate, like across the country. So it's one of the only publicly traded real estate debt instruments in the world. In the country. I mean, it's worldwide, but in the country. And so just like seeing what they did, how they like analyzed the property, because like in a sense, it's pretty boxy. You have to put things in a box, and I'm getting a bit technical, aren't I?
Oh, don't worry. Keep going.
Yeah, you have to put things in like this like box so you can securitize it and sell it off as bonds. So you have to like get really good at underwriting because you're not keeping it on your balance sheet. So workouts are a little bit different. So like some of the strategies are different. But just being able to see the impact of it, like the fact that they securitize, like they were able to finance various, like a lot of the casinos in Vegas were financed in the CMBS market, like various hotels, a lot of New York skyscrapers were financed there. So it was just really cool, like talking with him and seeing like the impact and seeing and like, and also the other thing that really was cool is like you get to go visit the buildings as part of your due diligence. So yeah.
Got it. And what got you interested? You in the very beginning, you said real estate was something you were interested in. What drew you right away to real estate?
I mean, my uncle was a developer, and I just like that aspect. Like it's something is physical. People see it. People live in it. People touch it. Like we'll probably get to when we go to when we talk about the time at Carlyle, but like going into a community that you helped like build and talking to the residents there. Sometimes they'll tell you like, oh, you did this thing correctly, you did this thing badly, you should spend more money. Like all those things I think are really cool. Like I think I like that tactile aspect of it.
I as you're talking about the actual people you impacted and what they say you did well and didn't do well, can you give us some detail about that? What is like some actual feedback you've gotten from someone?
I mean, so it can be as minute as like you didn't pick, like you designed the floor plans wrong and the bathroom shouldn't be connected to the living room, shouldn't be connected to the bedroom directly, or like things like that. It can be as minute as that to going and talking and then they'll be like, we need more like police or social presence to make us feel safer. And then it becomes part of my role to figure out how do I how do I enhance the experience by making them feel safer in the building? Even if I can maybe get police, are there other things I can do to make their experience better? So like when you're a real estate investor, your concerns range that full gamut of you have to be like, my countertops, I want the countertop backsplash. It gets dirty really easily. Can you fix it? Or this is a lesson learned. Don't use that type of color as countertop backlash because it like gets dirty quickly too. You have to think through like where in the market you put your asset in terms for just social services.
Got it. So yeah, we're kind of venturing a little bit into your time at Carlyle, but before that, I do want to better understand your time at JPM so we can understand like how it really helps prepare you for your time at Carlyle. And I wanted to ask more about your time there at JPM and what your day-to-day looked like, because as you mentioned, the product that you're working on, I think also comes out in Wolf of Wall Street.
The residential version of the product.
Yeah, or maybe it was a different movie.
No, it's not Wolf. It's the one about the great financial crisis.
Yeah. Oh man, The Big Short.
The Big Short. Yes,
that's the one I meant. And the product itself, complicated, not very well understood even back then. And I want to understand now, like what your day-to-day was like when you were working there.
Yeah, no, definitely. So the day-to-day, like basic, like the way it would generally work is I work closely with one of the senior originators and one of the MDs. And he had a variety of clients ranging from REITs to like individuals who own real estate to like high net worth individuals, nation states, and they owned the real estate and they're looking for financing solutions. So this often could be we just finished constructing the building, we want to put long-term debt, or we are looking to turn around this building and we need short rate floating rate debt. And so they would approach him for him to offer solutions. And my day-to-day, my job was to really analyze the asset, make sure that like what they said in whatever offering memorandum or whatever email they said was something we could do. And that was like, you look, like it could start, usually first thing to do is you Google Maps it. You make sure like you go to Google Maps, see what's around the building. In parts of New York, that's unnecessary because you lived there, you kind of know, oh, it's a lipstick building. Like, you know what's there. But sometimes you're doing a deal in Seattle and you haven't been to Seattle. So it's like, oh, what is actually around here? So you start there. Then you do an analysis of the property. So who are the tenants? What does it do? Like what was the property used for? Is it a hotel, office, multifamily? And then you review their business plan that they come up with. So sometimes they're like, oh, we want to renovate so we can increase rents, or we want to do some defensive capex because we need to change our position in the market. So you do the analysis of that, and then after that, you then look at the cash flows of the asset. Where real estate, because of the fact that it's basically very cash based, it's usually just a straight DCF to value the building, and so you build out your DCF, and you think through, okay, this is how I think the building, this is what I think the building should be valued, and then this is the level of debt our market, given the current market conditions, we think the market can succeed, the building can bear in this market conditions and what we can achieve. And so this can be done on things as small as, like, I think the group there would do, the smallest loan was about $10 million, up to like buildings or portfolios that were like issuing several $1 billion worth of loans for them. And so depending on the asset of the asset or the deal the MD got that day, it could be quicker analysis, or if it's a portfolio of hotels, like that could take a long time doing.
Interesting.
And building out the model and like checking our assumptions and seeing how comfortable we are.
Got it. And when let's say if people are listening to this and they're like, oh, I think a lot of people are interested in real estate, and they may not have known about a career like this or a potential career, what kind of resources would you recommend for people for them to prepare for interviews in this type of function?
Yeah, so definitely. So thinking through that, I think Adventures in CRE, it's a website, and the website goes through basic like commercial real estate modeling. How do we think through and value real estate buildings or real estate like properties? Real estate uses some like idiosyncratic vernacular, so we don't use multiples, we use cap rates. We don't really look at depreciation and amortization and so our value is just usually just a straight cash valuation, so to speak. And so just learning a little bit about that. And then the other part is like commercial real estate is also pretty big. It's I think it might actually be one of the largest asset classes in the world, because everywhere has real estate.
Yeah.
And just thinking through where in that value chain you want to be in. So I was more on the debt financing for more institutional clients at JP Morgan, but there are various parts of it, like they're local. It runs all the way from like small local like developers in your community all the way to like the mega developers who are like related, who just build Hudson Yards. And so like thinking through where in the chain you want to be.
Got it. And when you were interviewing, was the process similar to other, I guess, like banks where it's like a first round interview and then a super day?
Yeah.
What was it like?
Yeah, no. So, I mean, it was part of the full like JP Morgan on-campus recruiting cycle. So the first round was the on-campus team. And so that was like Princeton alums. And then the second round was like various EDs and MDs from different like groups within, I think, since the securitized products technically fell on the S&T, so within S&T. And so a lot of those interviews, because they're not like, they don't really teach a lot of the things you're going to use on the desk in school. So a lot of it is like, are you keeping up with the markets? Do you understand what you're really going to, what you're actually going to, do you have an understanding of finance, right? And if you're particularly interested in a specific desk, they will then ask you like specific knowledge. So for me, it's real estate. So it's like, talk to me about like what's going on in the real estate markets, what is driving the market right now, any deal you saw that could be that was interesting. And like at that point, my dad had gotten a Wall Street Journal subscription, and I read it, and so it's like it becomes relatively because it's like every week or so there's always an article on like someone doing something in real estate.
Right. So. Do you remember the hardest interview question that you got? Or one of, doesn't have to be the hardest.
I think at some point I got like a brain teaser.
I hate those.
I do not like brain teasers. And just, I can't remember the exact brain teaser, but I just remember like, I didn't like the brain teaser. I managed to get it right, but oftentimes those just rely on like, have you seen a similar problem like this in the past? So.
Yeah, actually during my JPM interview, I was really surprised because I got a market sizing question, which is more like for consulting. But the question was, how many times does a Wimbledon ball go across the net during the entire tournament?
The entire tournament. Oh, wow.
And luckily I had done market sizing for consulting prep when I was recruiting for consulting. So I was able to like get through it. But I just like, if I did not have that prep, I think I would have been screwed.
I think, and like when JP Morgan came to campus, they did a lot of the people who had interned like helped with prep. And so like they gave, like, I was expecting that type of question.
Okay. Nice.
But still not a fun question. And market sizing is odd for finance. Like, were you going into a group that was more?
No, it's just healthcare banking. I don't know why. She was an associate and she came from like an engineering background. I guess she wanted to kind of just like maybe see if how I'd react under pressure.
Yeah.
That's the only really thing I could think of. And I will say also in healthcare and biotech, when you're building out models, there is market sizing involved. Yeah. Because you start from the total population, the addressable population, all that. You go down all the way from the total to like your total
addressable
number of people who can actually like buy the drug and all of that. So I actually do think that it does, like, it makes sense as to why she might have thought it was reasonable, I guess. Yeah, because she like probably looks at those kinds of models all the time. Yeah. And I worked with her on those kinds of models when I did eventually work at JPM. But I did also want to ask about your transition away from JPM to Carlyle. Did you actually wait before that? I did want to ask a question about your work-life balance. Yeah. So were your hours? What were your hours like in this job?
Yeah, no, I mean, I think they were less than like conventional investment banking. My roommates were investment bankers, so I had better work-life balance, but still wasn't great. So I would say it was probably closer to like a 9 to 9 most days. Depending on that's just probably more the standard day. And then if you have a deal or you're going to like the committee to approve a loan, you can be there till late. And then because you have to print the books and be back there early enough for the committee meeting. And so, yeah, I remember like there were times I was trading emails with my MD at like 11 midnight. He would sign up and I would have to finish the comments, print the books, get ready. So yeah, it varied. So like those days was like 2 a.m., 3 a.m., whenever it got done. Mm-hmm. But a standard day is probably like 9 to 8, 9 to 9.
Gotcha. I love that detail you brought up about the books because I now remember those days as well. You know, usually a lot of times meetings can be in the morning. Yeah. And then what Ojima is referring to is like you send the finished presentation to the print center, at least at JP Morgan. Yep. Then they can't do it like instantly because they usually have tons and tons of requests. Yep. So hopefully the guy, if it's a girl who's working there, if it's like they have capacity, then they can make you hopefully do it in a few hours or so. But that just means you're kind of waiting. And so I do remember a lot of nights just waiting in my cubicle, having nothing else to do, and then going and picking it up, flipping through every single page.
Make sure there were no mistakes.
Make sure there's no mistakes. You pray to God that there's no mistakes because if there is, then you have to like reprint and stuff like that. Yep. Definitely part of every banker's job. And now I wanted to kind of ask about one more thing actually for compensation. How did that look at when you're working in securitized products? Yeah.
I think it was generally like it was in line with what the other like investment banking analysts were getting. I think all of us had the same standardized base pay across the entire bank. And the bonus, I think, was generally in line. At least it was in line with what my friends, like one of my best friends was in JPM Fig, and I think it was in line with what he was making.
Gotcha.
At that time.
Yeah, so that's actually, because a lot of times people want to know, maybe I don't want to work like those crazy banking hours. Like what are some other jobs? 9 to 9 is actually still a lot for the average person. Did you work weekends, by the way?
Yes.
Okay.
Not as consistently, but generally, yes. Like sometimes deals would come in on Friday night evening, and I would have to get stuff to my MD's desk by Monday morning, or he would want to have a call. I've had calls on Sunday with him and principals. But yeah, so weekends, you're always on, like it's indeterminate. And so you have no control over it, which makes scheduling like things to do on the weekends a bit challenging. Because like a week out, I have no visibility into my weekend.
Right.
Thursday, I have no visibility. Friday, I might have visibility, but I have also gotten emails on Saturday morning, and I'm like, well, there goes the brunch plans.
Yeah.
It's time to go back to 383 Madison.
Gotcha. So then it seems like most jobs in finance, unfortunately for anyone listening, I guess, who wants like good pay and like a chiller work-life balance, most, I think, investment banking jobs will require a lot of those hours, weekend work, stuff like that.
Yeah. The only ones I think are like if you go more into like traditional sales and trading. So if you're like selling derivatives or you're trading derivatives, there you're more aligned with market hours. And so you generally will have less work on the evenings, or clearly more predictable work on the evenings.
Yeah, that's true.
On the weekends. Sorry.
Gotcha. And then as you were transitioning, what made you want to make the switch from your time at JPM into kind of like a more investing role?
Yeah, no, definitely. So the thing with working in debt is, and especially in real estate, is you do have some ability to influence a property, but you're kind of taking it as the principal or the sponsor brings the asset to you. So you have no asset control. And I felt that isn't as fun as being able to say, okay, I'm going to work in a place where I'm coming up with this business plan. I'm implementing this business plan. Like, you own the asset and you take control of it. And that was my main goal when I started like looking for my post JP Morgan role, is if I was going to stay within real estate, which I wanted to be in a position to at least have control over the asset. So that ruled out a lot of the debt roles. There are some debt instruments that allow you to take control of the asset, but so I was generally looking to go more of an equity route. And so, yeah, that's what informed my thinking. And like I had like different interviews with different firms, and I got JP Morgan. I got Carlyle at the start of the pandemic. So yeah.
Got it. And so was this an on cycle or off cycle?
Off cycle. It was off cycle. A lot of real estate. I mean, I think some of the like mega funds might stay on cycle, but a lot of the like real estate roles are off cycle. Just it's off cycle and hasn't really been on the traditional investment banking cycle. Partly because real estate is, a lot of roles are open to hiring people without the traditional, like, you didn't work at an investment bank. Like when I got to Carlyle, a lot of the associates I was with were not coming from investment banks. They were coming from like smaller, like investment real estate shops, or real estate like groups. There were a couple who did investment banking or lending in some form, but by and large, they didn't really, like, that wasn't a precondition for real estate.
Now, if you've been enjoying this episode with Ojima and have been learning a lot about the private equity industry and want to work in PE in the future, you're likely first going to have to break into investment banking just like he did. And I'm actually building my own How to Get into Investment Banking course that's going to be built by myself and also my Wharton MBA classmates who come from Evercore, Goldman Sachs, and another from JP Morgan M&A. And I also bring my experience from being the JP Morgan UC Berkeley recruiting captain for 2 years when I was at the firm, as well as an investment banking analyst. We're teaching the concepts not just by going through text and teaching you theory, but also helping you build high-level models that'll really help the lessons sink in so you can really crush your technicals when you have to interview for those investment banking jobs. And so if you're interested in this, be sure to sign up early because we're giving 50% discounts for early bird signups, and I'll leave a link to all of this in this episode's description. So then can you walk us through what kind of deals you worked on? So, normally a typical private equity is just like buyout of a company. You fund it maybe, 70%-ish with debt or something like that. And you operate it for like 5-ish years. Hopefully you sell it for like a 20% IRR. And what can you kind of walk us through the equivalent of what it is like in real estate?
Yeah, no, definitely. So there are two Carlyle. So I'll talk more from the Carlyle perspective. So Carlyle, as a mega fund, chose to do a relatively unique strategy for a fund of that size, in that they were going to do smaller equity checks to develop, to take, basically turn land into like new buildings, new apartments. And so a prototypical deal for their opportunity fund, which is the fund that targets 20% plus IRR, would be we find a piece of land or we partner with a local developer in a Sunbelt growing area, and we build a new building. We lease up the building and then we sell it on to a REIT, a pension fund, someone who just wants the long-term recurring cash flow. So that's the opportunity fund. That's the opportunity fund strategy. Then the other one was more of a core plus strategy, whereas you buy an asset and you just do fix it. You think it's not positioned properly. You can invest some capital, and there you're looking for like low teens, like a 10 to like 14% IRR type return. But you might hold this for like a 20-year span and generate like more of an equity multiple.
Oh, that's really interesting. It kind of sounds like then you guys are kind of just like developers, actually, I don't know, real estate developers in a sense. Like, is there, I don't know, what were like the main differences where maybe a real estate developer, which actually I'm not an expert in, but like maybe if on a small scale, I was going to go buy a house, fix it up, sell it, which kind of sounds like the core fund, versus maybe if I had enough money, I go pick a plot of land, I like create a building, as you say, like sell it off to some other asset manager or something like that. The Carlyle, I'm sure they brought their expertise in some way and all of that. Like, how did you guys feel like you had an edge in the market?
Yeah, no, definitely. So the way it often worked was we would form JVs with more local developers. And then these local developers, so the full investment process starts with, we have a thesis of, we believe, I think when I was there, we believe multifamily in growing markets where there's tight supply will perform exceptionally well. And so when that thesis is formed, and the fund head agrees, and everyone agrees that this is the thesis of the fund, or one of the theses of the fund, the various MDs and partners will go to the markets we've identified. So an Atlanta, a Nashville, a Miami, Austin, Texas, and we'll go and try and find local developers who have tied up land, who have land in that area, and we'll work and partner with them. Oftentimes they don't have the capital needed. They don't have, 60-ish million needed to build a building, or however much the building we're looking at to build is. And so we'll then say, okay, we're going to be we're going to be the financing for you. We are going to also bring other relationships we have. So like Carlyle has relationships with property managers because of Carlyle's size, relationship with like various GCs, things like general contractors who will actually build the building. And so we'll build the building together. And then sometimes we might put it as an aggregation strategy into our portfolio. So say we've built, like when this property is done, it's going to be one of like 10 properties of similar vintage across the entire Southeast. That might be more attractive for a potential buyer because they're like, we can get scale really quickly, or we need to put out a lot of money really quickly. So like that might get a premium, and then we will package them all together and then sell them off.
And I only have one experience with kind of remodeling, when my parents remodeled parts of our house when I was in high school. And things always went wrong for us. And it was always more expensive, over budget. Did that happen? Or were you guys so down to a T, kind of like had the system down where like there wasn't that much that went wrong? Like how was it like in execution mode?
A lot of things went wrong. I did have a deal that actually was pretty smooth, but by and large, most of my deals, something went wrong. I started at Carlyle in 2020, and about, I want to say 6 months to a year in, I started during COVID. 6 months to a year in, we started experiencing inflation. Lumber like blew through all our budgets. And
that's scary.
yeah. We had like a lot of interesting meetings because a lot of our partner developers also have to contribute money, but our budgets and they don't have the capital, and suddenly like lumber has blown through everything, and like we're asking for more money, and it just becomes a whole thing. So a lot of meetings where we had to renegotiate some of those documents, those legal documents, and come up with new economics for the deal. How then so lumber became an issue. There's a point where like finding labor was like there was a labor shortage of like skilled construction workers, and that was an issue in thinking getting in like legitimately finishing on time. You always have to be cognizant of like various government entities that might like not give you permits for electricity, and suddenly a deal that was supposed to develop to be ready and done in like a certain amount of time is stretched an additional 6 months, and then you're paying 6 more months of carrying costs for the deal. So like a lot of things can go wrong as soon as things are signed.
Yeah.
But when you conceive of the deal, usually we're building some buffer for like you're building like an additional cash reserve, an additional contingency. You give yourself some buffer on the timing. If things are not too frothy and you don't need to push all your underwriting levers, you try and leave some underwriting levers so that, okay, costs have gone through. We've exited our budget on cost, but we might be able to increase rents, so like our sale price will be higher. And so things like that. So there were a lot of my time at Carlyle, like especially when after deals were closed and like we were going through execution, and you're just like, okay, lumber has moved against us. We have no ability to influence the price of lumber. We didn't buy our lumber when the price was low. How then can we still make this deal work for Carlyle, or do we need to think about exercising like various options? We had like to like either sell the deal to other development partners, or like what strategy is it the best to
And what about the rising interest rates that affects, the debt you guys take on as well? Did that make a huge impact?
Oh yes, it did. Yes, it did.
I can see the pain you probably went through.
Oh yeah, that did. It impacted us in, I'll say, at least like 2 ways, probably 3 ways. So the first one is we took out a lot of loans. So there were deals that were done in 2019. And for those deals, we didn't buy any interest rate caps. And so the carrying costs became expensive when you underwrote debt at, 0.5% LIBOR. SOFR was at 0.5%. And then 3 years later, SOFR is at I think it reached like 4%. It got really high. And that just impacts your carrying cost.
Can you actually explain carrying costs? Because I barely know what it is. And I think most people won't.
The way I'm thinking through carrying cost is like just when the building is not producing any income, it's still under construction or development, you still have to pay, apart from just the construction cost of like the people, the lumber to actually build the building, you still have to pay in like costs of like taxes, insurance, interest to the bank. And so you still need to pay that in some way. So those are like the carrying costs of the deal, to carry, quote unquote, the deal until the deal is self-sufficient. And so, yeah, we like those blew up. Loans had to be renegotiated for that. So that was the first way, like in the operating of the deal. The second part is some of like our longer term hold deals came due for refinances, and the interest rate meant that we had to be careful about the leverage, and sometimes we had to put equity in to cover the leverage shortfall, since the cash flow the asset produced was lower than, like, while could still cover the debt, would not, like, the lenders weren't as comfortable with it. Either we did that or we bought expensive interest rate caps to keep our cost of debt constant. That was the second part. And the third part that is still currently playing through in real estate is higher interest rates, especially since like my entire working in history since 2018, very short, but for more or less for the past decade or so, like interest rates had been super low, and no one was used to transacting in a high cost market, in a high interest rate environment, and a lot of people put debt at really low levels, and eventually debt matures and you have to pay it back. And so like that would then have a knock-on effect on the sales market, because you have to then sell it, but the people you're selling it to can't get as much debt. And so they have to bid at a lower price, but you need to make your return. So like currently in like commercial real estate, there's a standoff between the lenders, the owners, the sellers and buyers to see who will first blink in terms of like there's potentially like a lot of defaults people are papering over right now.
Yeah, actually, I spoke with one investor who works in real estate private equity as well, and he mentioned that he's just kind of putting out fires every day right now, and it seems really tough. And you kind of mentioned that the investors are kind of used to a low interest rate environment for a decade. Although I'm curious, I wanted to know, for the partners at your firm who had maybe been through high interest rate environments or higher interest rate environments, like were they also kind of really caught by surprise because they were kind of just used to the environment we were in, or were they able to say like, okay, I've kind of seen this before and here's what we should do?
Yeah, no, like a lot of them had seen it before. And so they had the experience, like the fund head had been there for 20 plus years and had been I think he was the longest tenured fund head at Carlyle. So he is very, very like well-versed in real estate. And wasn't like working in this environment isn't bad. The issue is the pace at which the rates changed. It basically felt like 1 month rates are 1%, 0%. 10 months later, they are at 5%. And it's like, what just happened? And given in mind that a real estate transaction takes a couple months to come to fruition, so you might start working on an acquisition deal and it might not close for 6, 7, 8 months. And so just having that type of time gap means that like we had deals that were almost closing, and then like a week later, the Fed says, "Oh, we're raising interest rate," and someone will back out from the deal because it no longer pencils for them.
Yeah.
And so just the pace of the increase, I think, caught everyone unaware. And I mean, given the fact that it was a decade-long run-up of short rates, in order to win deals, I won't say like underwriting got very aggressive. And so things that would normally be prudent to do, like buy long-term, like if you're doing a floating rate deal, buy long-term floating like rate interest rate caps, went out the window because you are now trying to win all these deals and grinding and getting every piece of profit. So if you think rates have been low for the past decade, US economy was strong, at least like pre-COVID, why do I need to pay this cost for a interest rate cap so that even if the economy goes south, maybe they will raise it a couple bips, like 1 or 2%, like you'll be fine. So
yeah, I guess the economy is always kind of does the unexpected once in a while.
Oh yeah. No one expected COVID. No one expected that world, but it was the world we ended up living in and working as an associate, working as an associate, senior associate through. So those were always, it was fascinating just seeing it play out, because it was almost like we woke up one day and deals that were fine and progressing along were suddenly not fine. And we now had to suddenly start calling our banks and saying, hey, about that deal, that was good. It's not good anymore.
Yeah. When you usually, like sign a deal, then by law, it's kind of like binding, I guess. But when you try to reopen those negotiations, I mean, were any of the parties that you worked with very, I don't know, strict about things like, sorry, like you signed this, we can't do anything about it? Or there are a lot of parties where they were kind of receptive to being like, hey, like we're okay, we see what the situation is, we're open to renegotiating?
Yeah, Yeah, no, like so a lot of the banks were open to renegotiating, like at least extending the loan, because I mean, not extending the loan potentially leads to a default.
I
And
see.
suddenly a bank doesn't want to be a property manager, property owner, because that's not their core competency. So they're willing to extend generally if they have like assurances from us that we actually care and are willing to do right by the asset. Usually we'll have to pay some money in. So like things like that went like swimmingly. And generally like the industry is relatively relational. And so you don't want to get a bad reputation as like this person is really tough to work with and really hard to negotiate. So oftentimes it's like, and everyone realizes like, okay, we're living in this environment. And so it just behooves us to just work together instead of try and like screw the other person.
Yeah. Okay.
Apart.
That makes sense.
But yeah.
And I feel like given the situation that came about from COVID, rising inflation, interest rates, and working in real estate at the time, there must have been certain times or moments that were looking back kind of like, holy crap, like that was really tough, or I can't believe XYZ happened. Can you walk us through something like what you might call like a horror story of like back in my time in investing, or like anything that was really tough and challenging? Any phases? It could be a particular deal, or it could be like a moment.
Yeah. I mean, I think in hindsight, this is more humorous than not. One of the deals I was overseeing, our countertops were shipping in from somewhere in Asia, and they were delayed. And the funny part is when the LA port was like so backed up, is we knew the exact like ship tankers they all were, but there was nothing we could do. And so part of like my routine became checking in to see if those countertops had been unloaded, because we would then need to ship them to, I think the asset was in Nevada, and to get them installed, because you can't really open a real estate building without sinks, a multifamily building, and say, oh yeah, come and live in this place without sinks.
Yeah.
So that legitimately became my job for a couple months as we waited for that to get through. I'm not sure if that's like
No, I think those kind of little details are great, because a lot of times especially when you're not working in these kinds of fields of like private equity or being an investor, it gets very glamorized,
Yeah.
And when you think about this little detail of like calling each day and trying to see if the countertops are like coming through, that's one of those like little details of what you don't expect to be doing as an investor.
Yeah.
But especially when you own the asset and your skin's really in the game, then you got to kind of do whatever it takes to see the project through.
Yeah. And real estate, I think, is unique, and like it's very especially the way Carlyle did it. And I think this might be more unique to Carlyle. And like they were particular that, and the fund head was particular that the way we generate like superior returns is we are personally involved and we care about the deals. And so like when as an associate, like I could have left it to the development partner to do it, but I had to make sure it was on time, because he would also then make sure it was on time and the deal was opening. And like every month or month and a half of delay is like an extra $500,000 in lost profit. And I mean, that was more than what I was making, but is like an extra, like, and so like that then matters, especially given Carlyle's strategy of putting out a lot. Like I think it's an $8 billion fund, and their average equity like check size was like 30 million. And so like you're like each deal might not have a huge amount of profit. Collectively they do. And so yeah.
Got it. And I should have asked this earlier, but where was your office located?
We're in DC.
DC. Okay.
Yeah.
Are there a lot of offices, and why did you choose DC
for
this team?
Yeah. So
or group, I should say.
Yeah. I mean, Carlyle was founded, and has historic, like the headquarters of Carlyle is in DC.
Oh, okay.
Yeah. There was a New York office. There's a New York office, but when I got recruited specifically for the DC office.
And you kind of touched upon Carlyle's strategy / culture a little bit, and how it kind of likes to kind of function and work. And
Yeah.
so can you broadly kind of describe the culture at Carlyle? Like
Yeah.
how, and I know it also really depends a lot depending on the group you're in and then the office, but from your lived experience, how would you describe Carlyle's culture?
Yeah. First of all, like I'm speaking more specific to Carlyle real estate because it functioned like the way it ended up functioning was real estate was kind of separate from a lot of the firms because a lot of the larger firm, just I think the way the fund head ran it and there weren't a lot of like connection points with like our like corporate PE group or buyouts group or European real estate. So just the way it ran. So just to caveat that. And thinking like overall structure, the way Carlyle generally was set up is at the associate and senior associate level to some extent, you're split up into like an acquisitions and an asset management team. There is some overlap in the two, like in the sense that like as an asset manager, you're able to do like work on acquisitions, especially as you get to know the market. And generally once you become senior enough, it doesn't matter. You asset manage the deals you acquire. I was primarily on the asset management side, and that meant that once the acquisition side finished a deal, in some instances, like there were a couple, like I did a deal or two where I underwrote the deal and then I asset managed it, which is a different, fascinating experience. But generally, once the acquisition team finishes a deal, underwriting the deal, closing the deal, bringing it into portfolio, you then take over it and take it through disposition. And so that's generally how the structure works. And each asset usually has a minimum of 2, usually 3 people on it. So an associate who runs the model, the day-to-day, and then like a senior associate, principal, or VP could be one of the above. Like usually if it's a senior associate, it's like a senior associate and a principal, or a VP. So like 2 out of those 3 will then like sit in on the deal as a senior at that level to provide more strategic guidance, help with some of the larger decisions on like who to hire, if you're dealing with like a budget bust, they will then sit in on those conversations to say, okay, this is what Carlyle's stance is, and based on our experience, and they know the partners more. So that's generally how it functioned. Culture-wise, I think the culture was pretty good. One thing I appreciated, it was like, because I'm not sure if maybe because we're in DC or it was a COVID thing, but like a lot of the partners and the senior people like left to go home for dinner, which doesn't sound like a lot, but that gives you like an hour or 2 of not necessarily downtime. You still have a lot of work to do, but you get to like go work out, have an actual dinner. And then also they were flexible on, like they were relatively flexible, at least when I was there. This position has still changed, on like working from home. And so some days, like if I had meetings starting at 8 a.m., I would just work from home all day. And so there was some flexibility in going back and forth with the office. Apart from that, the people were generally really nice, like really smart, really liked and knew about real estate. And gradually, like as you get more senior, you tend to specialize in certain markets and certain industry classes. And so it's like I worked on multifamily, active adult, which is multifamily for 55-year-olds. I worked on medical office buildings. And so like the senior people on those teams were experts in those particular asset classes and in the particular markets we were in. So it was always cool picking their brain, and hearing about their experience. And then it's like, it becomes like real estate oftentimes becomes like a story of like what happened in like I remember talking to one of the MDs about why my asset was underperforming. And then he was like, if you go back to the storm in, I believe it was like in Atlanta in 2018, and how like it like changed public housing and moved people to certain parts. And so suddenly it's like you get these expansive knowledge of like what happened in like a decade ago and how it's suddenly impacting your deal today.
Yeah.
So it was really cool.
That's really interesting insight. And yeah, I feel like the more senior you get, you see all these historical events and you get a lot of pattern recognition and all of that. I wanted to ask you a little bit more about something you just said, though. You said the process of acquiring and then asset management, that part was fascinating to you, or something like that.
Oh yeah.
So I was wondering if you could touch upon that
So
a bit more.
acquiring a deal that you own, you then go on to asset manage. Because acquisition, your incentives are to close a deal, and asset management, your incentives are to like get a deal to succeed and to be realistic about a deal, right? Like I can't asset manage a deal if they're telling me to achieve 50% rents higher than the market with an asset that might not be at 50% superior to the market. But you have slightly different incentives in those two roles. And so what you do to win a deal might not necessarily be what you do to asset manage the deal.
Yeah.
And so there's always a little tension in like the acquisitions guys will close a deal. And suddenly I call them, like I get the deal, I read through it and I'm like, wait, I know this market. These assumptions you just did are complete, like, no, I won't say, are very rosy. Yeah. They're very rosy assumptions.
It's easy to put in numbers and expect something to happen.
Yeah. And then I'm sitting here and I'm like, I actually have to go make this number happen. And I'm like, who told you the price of lumber was this? It's not that. And so that was, but then when I got to do it and had to face the two incentives and like was talking to the MD on the deal and just, he was like, yeah. And I mean, the senior people all know it and they understand it. And they do, like, when they think through the deals, they do put some leeway into that because they understand that like you're two slightly different models. And then on the asset management piece, but that's where like the attention to detail, the diligence like comes in trying to make sure that you reach the lofty assumptions that acquisitions puts in for you.
Yeah, I could totally I think about my experience from, well, first of all, in banking, like I put together models or whatever. The actual deals, I never was a part of that, so I wouldn't really know. So I guess I was more on like the acquisition side where I just putting in numbers. And then once I started entrepreneurship and I had to build my own like little models for what I expect revenue to be and etc. It was so easy to put in assumptions that are rosy. And then when actuality hits, I'm like, oh, I really didn't hit those numbers. So, yeah, I totally get that. And having the experience from both sides, I feel like is actually very, very valuable.
Yeah.
So now I'm much more conservative with my projections. But
you're more realistic.
Yeah. Which for me means being more conservative. I also wanted to ask, as you were talking about the culture, a bit about your work-life balance. After working at JPM, now at Carlyle, what was real estate investing, work-life balance kind of like?
Yeah, I will say it was better, not necessarily from like an hours like perspective, but more from the perspective that it was much more predictable. And so it's like I knew certain periods of times would be busier than others. Like we met with, like when we're meeting with the fund head on every single deal every quarter, like that 2-3 week period is like completely like I'm going to be grinding and working very, very long hours. But the fact that I could plan that meant that I could then also say, okay, these other weekends are free. I can then like have trips, go see family, take vacations. And that's something banking didn't really have. And like banking, you were at the mercy of whoever called your MD that week. So that's the first thing in terms of work-life balance. Second, I joined during COVID. And that meant that I started remotely, which came with with the flexibility of remote working. So it's like, there was a time I worked in my parents' house in Indiana for a bit. And then after, I'd also spent a bit of time working in like a couple of friends from college did like a co-working house in New Hampshire, spent some time there. You're able to like work and travel and do all these other things when you start working from COVID. And due to the idiosyncrasies of the group, Carlyle, like the real estate group was slower to come back fully into the office, which I found really helpful because it allows you to like be more flexible with your time. So I found that really, really great. And then the other part of working in real estate is the fact that you have to travel for your assets, especially as you get more senior. and I liked it. I think it's really cool to like, hey, to just go see it, see a real estate building and tour it and talk to the people there, tour like walk around the neighborhood, like just really cool to just really go do that. And so, and depending on your portfolio composition and if you have any particularly troubled assets that you have to go often, most people are usually traveling like especially at the associate, senior associate level, like 2 days, 2 to 3 days every 2 weeks. And so you just have to build that in. Some portfolios require more travel than others. Mine towards the end was like a relatively travel heavy portfolio. But yeah, so that I like that part of it, but like that's a different part of the aspect. Other real estate firms that are like, oh, we're a New York firm, we only invest in New York. You'll still go to your site, but your site is just a
few subway stations away.
Yeah, subway stations away. Yeah. Whereas I had assets in Atlanta, in Las Vegas, in Seattle, and I would have to go see them, meet the teams and things like that.
A lot of people who come from finance backgrounds, whether they worked in investment banking, private equity, or venture capital, eventually get their MBAs just like Ojima did. And if you're interested in getting into a top MBA program, be sure to check out my recently announced course, Liquid MBA. I'll leave a link to it in this episode's description, and be sure to use the code WELCOME25 to get 25% off. And I wanted to next actually ask about, since we asked about work-life balance, compensation, if you're comfortable sharing some figures of real estate investing compensation.
So I think the base is probably in line, is at least it's like I think it ended up at like 150, 200. I'm not sure how specific the numbers are. I think overall it's at the junior levels is probably lower than like a pure buyout group. And I think, I'm not sure if it's like specific to Carlyle or not. But it's like, it might not be as high as like pure buyout. At the same time, my work life was a lot better than like my buyout friends. So I would make that trade, and I looked for it, and I had fun making that trade. So I also lived in DC, which influences like some of the numbers, since DC is a lower cost of living city than New York.
Got it. And we don't need to go into exact specifics, but was it like 150, 200 all in, or that's the base and then
is
there a bonus?
And that's a base, and then you'll get a bonus. You get a bonus, like I'll say like 30 to 60% of whatever your base was.
Got it. And then carry, is that starting like the VP level, or is it senior associates also?
Yeah. So you get co-invest. As starting, I think after your second year at Carlyle, or at least specific to my group, where you get to like, and they will lever you up, I think 2 or 3 times in your co-invest, which could become very lucrative. So you start doing that, and then you start getting carry as a VP.
Got it. And co-invest, for those who don't know, is you put in your own actual money into the fund, and then, as you're mentioning, a lot of times they'll lever whatever deal they're working on so that you get multiples of your money. Kind of like when you get a mortgage for a house and kind of lever your money. But I always thought co-investing was definitely a great opportunity, but it's also kind of funny because it's like, oh yeah, here's the money you made, and let us take some back. We'll make more for you, but let us take your money for that.
No, I mean, you just in doing co-invest, there are 2 ways to view it. One, you can view it as a vote of confidence in what you're doing and in your team and in your deals. That's one way. The other way is you can view it as you're just becoming highly correlated in terms of your net worth and your income to your job, which depends on how you view your job. Could be a good or bad thing. So,
yeah. And I wanted to also ask about, throughout your time at PE, there's so much that you go through, and it could be mentally, emotionally, physically sometimes. Could you give us like one lesson that you feel like was very, very, I don't know, a strong personal or professional kind of lesson or skill that you developed?
I think for me, what ended up helping was, I guess, learning to communicate. And the way I think about it is just like given, like the way it worked is I was on deal teams with maybe 2 or 3 different partners at any given time, or MDs at any given time. And every senior person believes their deal is the most important deal in the world. For you, who is on 3 of them, it might not be. And so the onus is on you then to just go and go to be proactive with your MD and just be like, hey, I am working on this deal for you. It's great, but I'm also working on this other deal for another MD. And you're on similar deadlines. I'm only one person. Is there anything you can do to either like talk to the other MD to change their timeline or change your timeline? And people are generally receptive and they understand, like, you're one person. You can't be split yourself in 2. So just learning how to communicate and manage up and manage expectations, like, really like helped make the experience less stressful for me.
On that similar vein, I also wanted to ask about if you had any productivity tips or hacks that you might have picked up.
Yeah.
Because investors have a lot to deal with, and there are various different aspects of the process and the deal that you always have to manage. Any productivity hacks that you can share?
Let me think about this. I am a believer in the 2 phone things. When I was at Carlyle, I used 2 different phones, one work, one personal. And generally what helped me was, on days that I needed to be really busy, I could put my personal phone into like a do not disturb mode. And the way I did my do not disturb is like there were like 5 people who could always get through do not disturb, like my mom and my sisters. And so like my phone would not vibrate unless it's from them. And they generally would only call me if it's like something's actually important happening. And so like I was able to then ignore that. And then I just had my work phone, which was all work. And so just allowed me to be a little bit more focused, as opposed to like having everything on one phone, and which I had at JP Morgan. And just like, oh, you get my work email, but I also get my personal email, I get my Instagram notifications all on the same phone, and suddenly you're getting distracted. I'm not sure if that's a productivity tip.
No, I totally remember those days, because I also had one phone for both.
Yeah.
And then, the work emails would just go off nonstop.
Yeah.
And then, I could also easily just go onto Instagram and, like, Yeah. What about like to-do lists? Like, how do you keep track of everything? Like, what do you do for those kinds of things?
Yeah. So I am a big to-do list and calendar scheduling person. Like, my mantra was, if it wasn't on my calendar, it did not exist. And I mean, I've gotten better, but like, it was bad enough where like I would schedule, like I had to schedule personal time and put it in my calendar. If not,
I do the same thing.
If not, like, it didn't exist. So just like making sure my calendar was up to date, which sounds like a lot of work, but like once you get into the flow of like, oh, we want to have coffee at this time, you put it in. You're like, okay, when I finish a site visit, it's like I need to schedule my next site visit then and there to make sure that, okay, I know, like, just to block out that day that I'm going to be traveling this day, instead of having like it just creep up on you. So like making sure your calendar is up to date. I'm a big fan of to-do lists, but like not just like a to-do list of everything, but you have to organize it by priority of what's important and what's due as soon as, like, what's due soonest. And then like you negotiate the rest. And that's where like communicating with the senior people comes with, because you also ask them like, hey, these are the 10 things you've told me to do. What are the 5 things you need from me within the next week?
Yeah.
So
got it. And you were working, in investing, and a lot of times, a lot of our classmates want to actually go into investing after MBA. What made you want to decide to get an MBA?
Yeah, no, definitely. Great question. I think primarily I wanted to see and explore the world outside of like real estate, talk to people, and like take classes in those different types of subjects. And on top of that, like gain like a more quantitative grounding in finance and real estate. Because I had studied civil engineering. Coming out of college, I knew how to design a beam. I don't know how to design a Bream anymore, but I did know how to do that at one point. But I needed to learn, like I wanted to get a better grasp of like finance and like that type of knowledge, because a lot of my knowledge was like self-taught. And as I got more senior, I realized there were holes in it in different aspects. And because there's some things you learn in college, or if you're doing like an econ or finance undergrad, that I just hadn't learned. So that was one aspect of it. The other aspect of it was I wanted to explore other types of investing. So like while at Wharton, I've been able to like join the PVC club. Like I'm going to be doing distressed investing for the summer. So just like explore some of like what else is out there outside of real estate, and see if there are other types of investing or career paths that might be of interest to me. Jury's still out on that. So, yeah.
Gotcha. Cool. And I wanted to ask, in your first year, what has been a kind of like standout experience from your time at school?
So I did a leadership venture. I did the Atacama Leadership Ventures. For those who don't know what a Wharton Leadership Venture is basically they take you to somewhere outdoors in nature, generally international, but they do have one in Alaska. And
that's close to being international for most Americans.
It's part of the U.S. It's part of the U.S. So, but yeah, you go there and you're basically backpacking and hiking and sleeping in tents for about a week. And I think it's a phenomenal experience because it's something like coming from a desk job you don't really do, just to go out and be in nature. For the first time in my life, like, or at least in my adult life, I saw the Milky Way galaxy as like a Milky Way, not just the stars, but like I was like, oh, that's why they call it the Milky Way, which is super cool. Like, and I was like, okay, this was worth it. But apart from the goal of seeing like great sights and like hiking, but the goal is also to like teach you like leadership and like applying like leadership skills and team building and teamwork skills in environments that you are not used to, with people who you might not necessarily know. So that was also great. Like I had a really good like team there and I got to know them pretty well. And yeah, and Atacama is pretty hard. It's high up altitude. I got some altitude sickness towards the end, but seeing the Milky Way like out there watching like shooting stars was well worth it.
Yeah, there's nothing like really juxtaposing nature with your previous life of just like always being maybe in a cubicle. It sounds like you traveled a lot and saw a lot of sights and stuff like that when you're in your investor role. But yeah, I do remember like leaving JPM and then I backpacked and traveled for around 6 months, and then just like not just nature, but also city and just experiencing so much that's out there. I think that's one of the best parts about school as well.
Yeah.
And I just have a few last questions for you that are a little bit more miscellaneous, but
okay.
One is, what do you think makes for a good investor?
What makes for a good investor? So I'm thinking, and what I think kind of part of what's playing in my head is like things like the fund head, Carlyle would say. And he was really big on patience, and patience coupled with like a rigorous decision thinking through and like decision making process. And there were investments that like people on the team, including me, were like, we should sell this. Like, it's not doing well. But he's like, we've done the research, we did the work, we are patient, and we will not be forced sellers unless we have to actually be forced sellers. We don't. So that's just something like that stuck with me, like just being patient. Sometimes you actually not doing that deal or holding on to the deal might actually be better than just selling or like, so yeah, just that type of patience.
Yeah. I like that actually, because it's not the first thing you think of when most people may not think of. They may think of like analytical rigor or like, I don't know, being up to speed with the markets and whatnot. And then since, I've got to ask you about real estate in general, like where do you kind of, well, first actually, something a little bit more applicable to most people. When it comes to investing in real estate and in general, like when it's more of like a personal thing, like purchasing a home, anything like that. I don't know if you have any properties, but I'm guessing you've like looked into personal purchases and all of that. Do you have like just general tips of like when you're purchasing an apartment or anything, things to really be mindful of?
So apart from like, the first thing I always say is make sure like the quality of where you're buying like is appropriate. So simple things as you're doing a tour, run the showers, see if the water pipes and water pressures actually is there. But like make sure, like check for quality, make sure the wood is good, drywall still good as the physical aspect. For a personal house, I think a couple things I say to my friends. One, it's at the end of the day, a personal house, especially one where you're going to live in, is more of a personal and a consumption good. You're going to live in them. You're going to consume, quote unquote, consume the house. So make sure it's a house you want to actually consume. Like it's a house and a place you want to live in, you want to sleep in, maybe have a family in if you're going to do that. So that's if you're buying a personal house, like keep in mind it's a consumption good. Along with that, like don't stretch your finances for a house, because a house, while it's an asset, can also pretty quickly become a financial burden. And so those are the two, like, and then make sure it's actually good physical and good quality. But like those are the three things I tell people if it's a personal investment. If it's more of like a financial investment, I think then it's more like you're looking at things like, are you buying in a good market, in a good area? Do you think you're getting a good basis for the asset? And then one very important thing is think through who your ideal customer in this building you're buying is, and will the surrounding amenities work for them? So if you're buying in a place and you're like, oh, it's gonna be families who are gonna rent here, like make sure you're buying in a place with a good school district so that the kids can go to school. So things like that.
Gotcha. I really like that mindset of your house is something you're consuming. I hadn't thought about that in that way before. But I've thought about it in generally, but I think putting things into actual words a lot of times really crystallizes what you're actually doing. And one last question about real estate is like the market has been so hot as of the filming of this video for real estate, and things are just kind of flying through the roof, perhaps because private equity firms are getting involved in purchasing up, the land and good properties and all of that. Do you see the market kind of like, obviously no one can tell the future, but do you see the market ever kind of correcting to the point where more like average kind of middle class people can, take out mortgages and purchase homes in good neighborhoods again? Like, where do you see the market kind of going?
Yeah, no, and I think you're specifically talking about like the residential market. I believe like nationwide, and this is specifically acute in certain places. I think America hasn't been building enough homes. And so there's, I think, a fundamental like supply and demand issue. Like there's not enough supply of housing for the amount of people in the country. I'm a big proponent of like, we need to build more in a sustainable and economic fashion, but I do think we need to build more. And personally, I believe until like we start building more houses, there's going to be upward pressure on prices. And this will be more acute in places where people are moving to and like the population is growing fast. So that might be a lot of your Sunbelt cities or Sunbelt states. Because keep in mind, housing is not a good that just flexes up and down on supply. It takes years to build a house, to like take it through like from land through entitlement to the physical building. So it takes years for that to correct itself. But I wouldn't be shocked if like the upward pressure on prices continues for a while until like various like state and local governments will push and like will change the incentive so that like people will build more housing, and then that will then reduce like the price. The prices will probably not rise as quickly.
Got it. Yeah. Well, hopefully by the time I don't know, we all start purchasing houses, they're more built. But and one kind of last catch-all question I wanted to ask you is, if you could go back to your 20-year-old self, kind of give either personal, professional advice to your former self, what would that be?
Personal, professional advice. In thinking through like the advice I would have wanted, I go back and forth. I think I would want them to know, like, enjoy the moment you're in. Like it's gonna be hard. Like JP Morgan was hard, but find the places you enjoy there. Like explore. Scratch that. Actually, it's gonna be explore New York. And I get, like, as a banking analyst, you don't really have the time to do it. But I would have told myself to make the time for like an hour or two every week, if you can, to go to a new part of the city and actually explore the beautiful city that you live in, because New York is pretty awesome. And like my experience was dominated by my time at JP Morgan, and I didn't get to actually experience the city. But now I go back and I visit, and I get to see things I couldn't see then. Especially I lived in the city pre-COVID. And so that would have been a great experience. I was able to like later like explore DC more and like live in DC. But I'll just say, like, explore New York. Like, life is tough, but like it's a beautiful city. Great buildings. I love the New York skyline and the history and the stories behind, like, why is that building designed that way or called that name? So things like that. Yeah.
Well, I think that is also applicable for almost any city you live in. I think you forget that sometimes it's fun being like a tourist in your own city. Oh yeah. And I actually just went to New York this past weekend, had a blast. So I know kind of exactly what you're talking about there. But you know, I learned a lot from this interview, and I had a lot of fun talking about real estate, something I'm also very personally interested in. I think generally speaking, a lot of people are. So thanks so much for sharing your time, your advice, insights, and just making the time for this interview.
Yeah, thank you very much. Thank you for having me on. Awesome. It was fun.
All right, I hope you enjoyed this conversation with Ojima. I certainly learned a ton about real estate and the real estate private equity industry. And I think the story that'll really stick with me was when Ojima had to keep calling the port in order to release the countertops in order to make sure that construction would go smoothly. And I think this was just such an interesting story, because a lot of times private equity is glamorized, but in order for Ojima to make sure that the investment that that Carlyle made would go smoothly, he had to roll up his sleeves and do some of the quote unquote dirty work. And I think that's true not just for private equity, but so many other jobs. A lot of times you just have to say, no job is beneath me, and just get the job done. And so that's what I really took away from this conversation. I also wanted to ask that you share this episode with anyone you feel like would be interested. That'll really, really help this podcast out. And thank you all so much, as always, for joining. Hope to catch you all in the next episode. Thanks, guys, and peace out.